Welcome everyone on this presentation on risk-based capital. My name is Sonjai Kumar and I am an independent risk management consultant. I am a certified risk management professionals from Institute of Risk Management London. Risk management is kind of my passion and I'm trying my best to take risk management profession across the country. Uh, for this particular presentation on the risk-based capital, as you know that the world is moving towards risk-based capital away from the formula approach. So this is not only happening across the world, but it's also happening across the Asia Pacific and under the banking and insurance sector. um, the, the jurisdictions are moving towards risk-based capital. In India also, in the banking sector, the RBI is focusing on Basel II and Basel III, and in the uh, insurance sector, Indian regulator IRDA has mandated to move to the risk-based capital by March 2021. Recently, I was involved in a guest lecture at National Insurance Academy, Pune, to give lecture on risk-based capital. And after that, the thought came to my mind that why not have a general session for everyone. So, welcome to this session. And this is particularly linked to the life insurance side, but can be very easily applied to the non-life and health insurance. So let's start, and explore that what is there in the risk-based capital. The agenda item that we have for today is what is risk-based capital or what is economic capital. We shall touch upon what is the difference between the traditional approach or the Solvency I approach that currently Indian jurisdiction have, and the difference between risk-based capital. We shall also cover how capital is calculated while in risk-based regime. As you know that risks are interrelated, therefore there is a correlation effect. So we shall also touch upon the correlation between the risks and the diversification benefit. Where does the India position currently on the risk-based capital? We should explore that and what are the roadmaps, and we shall in the end also see that how does enterprise risk management help in the capital, in the capital which is the calculated, because when it is a risk-based capital, managing capital help in optimizing the risk-based capital. So let's move forward to see that what is there in the risk-based capital. So let's understand what is solvency capital in the insurance business. If you look at the boxes on the right hand side, you will find that in the right bottom corner there is something called policyholders liability. So because insurance is a long term business, therefore the insurance company has to set up policyholders liability. This is because the premium is paid over the period of time, and the incidences of expense and the outgoes happen at a different period of time. Therefore, the insurance company is to set up the policyholders reserve. So reserves are used particularly for the purpose of uh, mm, rising future claims and the expenses and the maturity payout which insurance companies keep. And over and above that, there is a regulatory requirement that the insurance company must have the solvency capital. Solvency capital is an amount which is kept over and above reserve, which cannot be touched otherwise. and this solvency capital is the shareholders' money. So we have to also consider that it is the shareholders' money which they are locking up for the insurance business, and therefore, um, because they are locking it, they must get a decent return on the solvency capital. Over that, there is a free assets are there to write new business because the business is in a continuous mode. They will be writing new business, they will be incurring expenses, and therefore they need extra capital to do the new business and the management of the expenses. So on the left hand side, so what we have on the right, we should have assets equivalent to what is required for reserve, solvency capital and new business. The important point to mention here that the solvency capital or the risk based regime that we are talking is about the middle box, which is light blue, is solvency capital. So we shall see that in this presentation we shall be talking about this solvency capital, and what we have to look into the presentation is that the how does the solvency capital is calculated now, or it is in the solvency 1 regime, and what is the difference in the risk based capital. This is covered in the next couple of slides. In order to understand what is risk based capital, we need to understand that what is the current way of calculation of the solvency capital, because if we understand that, then it will be easier to one, the differentiate and to appreciate that what the risk based capital is about. So the current way of calculation of risk based capital is that it is based on a formula. And what does this formula says that is written in the screen is X% of reserve and Y% of sum at risk. These two X and Y are variables, and that this depend upon the type of product being sold or manufactured by the insurance companies. If say for example the company is manufacturing endowment assurance product, then this X is 4% and Y is 0.03%. If the product sold is unit linked product, then X is 1% and Y is 0.01%. And similarly for the term product, X and Y is different. So as you can understand that the current method of solvency calculation is the X% of reserve and Y% of sum at risk. And the sum at risk is defined as sum assured minus reserve. What does this mean is that the company is keeping reserve for the future contingencies, and the difference between the future contingency and the total money at stake is a difference, and that is what the sum at risk is. So it is a nice formula currently used by the jurisdictions where they are using Solvency 1 approach, and you will find that in this method it is a very simple two-factor method, easy to apply and easy to communicate and calculate. The challenge in this formula is that there is no rationale behind the X and Y percentage. At least my research, I was not able to find out what is the rational background behind this X and Y percent. I did some research on how does the solvency started, and what I got that this solvency formula came from the Europe, and in 1973 around it was first applied to the non-life companies, and then it was taken up by the life companies with the modifications. Later on there was some more modification in the 90s, but the rationale behind the X% and Y% is at least not known to me. Now, what are the challenges in the traditional approach? Um, First, as you can see, this is based on the formula, and therefore it is not a direct function of risk, right? Because reserve has its own formula, and whatever it comes out is an output, and then the percent is applied. But somebody can argue that it is hidden within the reserves. Now this presents a second challenge. If any company want to strengthen the reserving basis, it means that the reserve is going to increase, and as a result of that, when reserve is going to increase and the 4% of reserve will be taken, there will be a double hit. There will be a double hit on onto the shareholder, that on a one side they are deferring the profit, and on the another side they are also keeping the higher solvency capital. So the any prudence in the reserving method gives a hit in increasing the solvency capital, which is in fact impact on the to the shareholder. Also, there is no direct benefit of risk management, because the formula does not have explicitly anything on the risk management, and this is perhaps could be one of the reasons why, when I talk to the different people in the country and read different write-ups across the different places, that the risk management is still is more like a tick in the box exercise. The reason could be that the shareholders are not getting impacted, because it is not a function of the risk. So at present, the risk management does not help in at least impacting the capital position of the company. Another, the easiest way to understand the difference between the Solvency 1 approach and the Solvency 2 approach, that is the traditional method and the risk-based capital. If suppose there are two companies, they are identical in nature, in every respect, but one company is doing risk management very well, while the another company is not doing risk management so well. Now what will happen is, if any adverse event happen, then the company which is doing risk management very well will basically in a better position, and there is a possibility that the company which is not doing risk management very well may face a solvency issue, right? And there could be a chance that if the situation is very bad, it can collapse also. But because the formula is same for both the companies, right? In reality, when you use solvency 1 formula, you will find that both the companies having the same capital, despite one is doing very good risk management and while another is not doing. So there is no direct benefit it gives you in terms of the risk management. The one advantage of moving towards the risk-based capital is that it allows you to have good risk management. It also allows you, once you have risk-based capital for each risk, you basically come up with the risk profiling. You come to know which risk is basically more in your company and how you can manage the risk. So that's a fundamental difference between the two approaches. Now we have seen that how does solvency capital is calculated under Solvency 1 regime or using the formula. Now let us see that how does the capital under risk-based capital is calculated. This is actually based on the statistical method, and the method is called VAR approach or value at risk approach. And to understand it in a very simple language, if suppose we have historic data of say 100 or 200 years of the losses, and if we arrange the losses in the increasing order of the losses, let us say from the 100 crore to 200 crore, 500 crore, and so on and so forth. So if we arrange in a sequential order, then what we are saying is that we have got losses of each year. And if we pick, say for example, 95th number of the losses, which is equivalent to say 500,000, and this can be in a unit of 500,000 crore. So what it means is that if the history repeat and we keep capital equivalent to say 500,000 crore, then if that event will happen, then company will get protected. Now in this case we are using historic data, but there could be a possibility that there is no historic data available, for the losses of 100 years. Then in that case, artificial simulation can be used, whereas artificial simulation can be taken from one of the distributions, and that could be the normal distribution, and it can be plugged into the assets and liabilities and find it out, the what are the losses that is happening. And again, based on that output, we can pick 99th or 95th percentile based on actually 99 or 95 or whatever percentile that we pick. It can be picked based on the risk appetite of the company. Under the Solvency II regime, it is 99.5, 99.5th the value is picked, and then that value is equivalent to 99.5 confidence interval. The point to note here in this is that the data is on the yearly interval, and when we are saying 99th or 95th, that is the confidence level under the statistical distribution. So what it says is that if you keep that money in your account, what will happen is that you will be saved for at least till that event, right? So yeah. So taking the risk-based capital calculation forward, as we said that um, this is based on value at risk approach, and in a statistical term, it says that this is the maximum loss that a company can suffer or can bear within a given time frame and within a certain confidence interval. Say for example, when we are saying within the time frame, because that data can be on a daily basis, it can be on a monthly basis, or it can be on a yearly basis. And when we are saying about the confidence interval, the probability or the risk appetite can be 99 or 99.5 or whatever chosen by the company. In fact, this all started by the JP Morgan, and they used to call it at the 4:15 report in the evening. So what used to happen is that the CEO of the company need to have a calculation at 4:15 p.m. every day, that how much capital he need tomorrow, how much money he need tomorrow, so that if the adverse event happen, he is 95% sure that the company is going to survive. And if you're doing this on an everyday basis, you can survive on a continuous basis. So this was the beginning of risk-based capital in the banking sector. Now, this can be, as we said, that the calculation can be done the based on the statistical model, right? And what we call is that the internal models, and where assets and liabilities are projected, and the value is picked based on the calculation. The other simplified way of doing the risk-based capital calculation is using the stress testing. So instead of projecting assets and liabilities, the assumptions or the risks, basically, like interest rate risk or the mortality risk or equity risk, the shocks have been developed equivalent to 99.5% or whatever chosen basis. And if those shocks are applied on both assets and liability, for both the scenario, for the base assumption as well as the stress assumption, then the difference between the two is basically uh, is the risk-based capital or the economic capital. So in some jurisdictions, internal models are used. In those jurisdictions, the internal models are reviewed by the regulator, and in some jurisdictions, stress test is used. So that's how the risk-based capital calculation is performed. So what is risk-based capital? So we have seen that the in the risk-based capital, each risk is considered, and for each risk, capital is calculated, and then they are combined together, right? That's how the risk-based capital is different from the Solvency I regime. But we have to also notice that the risks are interrelated. There is a there is a interactions between the risks. Say for example, interest rate and equity, mortality and lapses, mortality and longevities. So these risks interact each other, and when we do the aggregation of all the risks, it is not just the sum total of all the risks. So on a one hand, we do sum total of all the risks, and then we allow for the diversification, because there is an interaction between the risk, and that allowance is given to the insurance companies. So that's a one advantage. So risk diversification allows company to manage their risk or choose their risk in such a way that they can optimize the risk capital. So risk diversification is a tool through which the overall capital can be reduced. And there's a one more thing, within the risk based capital, is that management of the risk, because as we have seen that higher the risk and higher the capital, therefore the more emphasis is given onto the risk management, there is a optimization of the risk capital. Now we can see very clearly that why does currently the risk management is tick in the box exercise, because shareholders are not getting direct benefit of risk management, whereas in the risk based capital there is a direct benefit to the shareholders in terms of optimizing the risk capital by using the risk management. Now in the next couple of slides we shall see that we shall consider each risk and see how does it is calculated and the diversification benefit is given. Now if we look at what are the risks within the life insurance companies, and particularly those risks which are quantifiable, they are financial and insurance risk. Under the financial risk, the risk categories are equity, interest rate, credit risk, and liquidity risk. While in the insurance risk, there is a mortality risk, expense risk, lapse risk, and if you're selling the annuity product, there will be one more, longevity risk. Apart from that, we also have operational risk, regulatory risk, and you can name few. Operational and regulatory risks are not directly when the capital can be calculated. So for the operational risk, some proxy is done. So it can be seen that because in the risk-based capital, capital is a function of risk, and we can see that why in the risk-based capital the management of each risk is important. Let us look at some of these stresses, and these stresses I have taken it from the Sri Lankan market, because for the India market these stresses are yet to be defined. And as an example, in the first, the blue one is shown what are the insurance risk, and the insurance risk is that you have to stress the mortality assumption by 10% if there is a guaranteed premium. For the longevity risk, you have to improve the mortality by 15% at each year. If there is a lapse risk, then you have to stress the assumption both. You have to increase the lapses and you have to decrease the lapses by 20%. And for the expense risk, it is a stress on the 10%. So what it says is that if you apply these stresses on the base assumption, so this will be equivalent to 99.5% confidence interval on a yearly basis. On a financial risk interest rate, because we use yield curve in the interest rate, and in the interest rate no single shock is applied. So generally in the interest rate there is a range of shock is applied to stress it, and in this particular case the range is from 25% to 70%, both up and down shock, because for some product there can be risk when the interest rate increases, and for some product there is a risk when interest rate decreases. For the equity risks, there is a shock for 35% and 45%. However, just cautioning that these shocks can be different for different countries, and they can identify that what shock they are going to apply. Again, as said in the previous slide, the aggregation is not a sum total of all the risks because there is a allowance for correlation effect. So that's how the stresses are applied in the risk-based capital. So let's understand that how does the risk-based calculation is performed. These are shown based on the stress assumption and not using the internal models. As a result of that, one is that we use base assumption because the value of assets and liabilities is calculated at a base assumption. Say for example, the base assumption is 5% rate of interest, and we again stress the assumption, let's say interest rate stressing by let's say at 3%, and then the same assets and liability value is calculated 3%, and the difference between the 5% and the 3% of the value is what the economic capital for the interest rate or the risk based capital, because what it tells you that if interest rate move from 5% to 3%, then this much is the capital that you will require to sustain that period of happening. And these stresses are performed based on the confidence interval and the time frame. The example that I have taken is on the mortality risk, and the base assumption I have taken is, let's say it is 100% of LIC 9496 mortality table, and the stress assumption is 110%. So for different companies, the base assumption can be different. Here it is the example of 100%. Somebody can have 70% as a base assumption, and on the stress will be 10%. That is, in this case, there will be 110% of the mortality. And if somebody is taking a 70% as a base assumption, for them it will become 77%. So based on, as an example here, the value of assets and liability will be calculated on the 100% of the mortality table, and then it will be calculated on 110% of the mortality table. And let us say that the value one is calculated as 500, and second, when the stress test performed, it is coming out to be 700. So the difference between the two is the risk-based capital required is say 200 crore. So if the company has got 200 crore capital kept aside, then they can sustain the mortality increase from 10% to 110%. That's how the risk-based capital calculation is performed. The way we have calculated risk-based capital for the mortality risk. Similarly, such risk-based capital can be calculated for other risks. Say for example, lapse, expense, interest rate. So in this table on the left hand side is shown that the insurance risk, the economic capital is calculated, and the subtotal of insurance risk is 650 crore, let's say. And in the bottom, the financial risk, which is interest rate risk, equity concentration, these risks is coming out to be what, 800 crore. And if we add the insurance risk and the financial risk, comes out to be 1450 crore. So that's how the for each risks the economic capital is calculated and they are added together. And you can see that what is the difference between the Solvency 1 approach, which was based on one simple formula, whereas in the risk-based capital approach, we are calculating risk capital for each of the risks. As we said earlier, that it is not a simple sum total of all the risks because the risks interacts, and you can see that there is a minus 200 crore of diversification is given, and as a result of that there is a total of 1250 crore of economic capital is required. So that's the fundamental way that the risk based capital will be calculated. This will be based on the asset model that the life insurance company will have and the liability model that they have, and the stresses will be applied. Now the point to note um, in this calculation, it is not just as simple numbers. These are basically, you can say, these are the risk profile of the company, and a lot of information can be drawn from the type of risks that an insurance company is facing, and lots of strategic changes can be made based on the risk profile. Say for example, what type of product you are selling, so you can determine based on your risk profile. There is a possibility that some companies are selling lots of interest rate maturity guarantee products. You will find that in that cases the interest rate risk will be high. Similarly, if some companies are selling lots of protection business, they will find that their mortality risk capital is increasing. Because there is a diversification benefit, you may find that the mortality risk and the longevity risk interacts more, and in that case, you will find that there is a more diversification benefit. Also, you can identify where to sell, right? You, if you have your constraint of the capital, you may not able to sell much of the guarantee product. Also, that in which pocket you want to sell. So these are the uh, different benefits that you can see. Um what you will find that the companies which are more constrained for the capital, they will not be able to sell more of interest rate guarantee product, whereas then they may have to move towards unit linked business. It has been observed when in the developed market, when they move to the risk based capital, their product portfolio moved more towards a ULIP and the protection side, because there is a high guarantee charges under the guaranteed business. So there is a need to have a judicious choice of judicious choice of the product, and also the judicious choice of the diversification that you can take the benefit. So there's a lot to do. It's not just a simple calculation. There's a lot of the relationship is going through, and you can see that the opportunity that is available in managing the risk in the risk-based capital regime. Next we have is risk diversification or risk correlation matrix. These matrices are shown for the financial risk and the insurance risk. As you can see, that correlation is a measure of linearity of the risks. How does one risk behave with each other? You will find that the property and the equity risk has got value of 0.75. So what it also tells you that based on the way the risk is interacting, and if you're investing your assets in that way, there will be the impact on one risk to another. For example, if the property risk increases, you will find that simultaneously the equity risk is also increasing. So wherever as the correlation is increasing, you will find that if you choose those risks, then there will be a greater the linearity relationship between those risks. Onto the insurance risk side, you will find that the longevity and the mortality risk has got a negative value. It means that if one risk increases for one product, it decreases for the another product. Similarly, you will find that there is expense risk and the lapse risk is zero point 0.5. So it indicates that as the expense of the company increases, there is a chance that the lapse risk also increases. So what it tells you that this gives you a choice for the risk importance. For example, if you control lapse, though it is not given here the relationship between mortality and lapses, but in some way they also interact. It provides a way through which you can manage your risk and the choice of the different risks that you can have. So this matrix gives a very good uh, way through which you can choose your risk and invest accordingly. The next section is on the risk-based capital position in India. In this, we shall see that how does the Indian market is positioned in terms of the risk-based capital, and what is the view of the regulator. For the Indian market, risk-based capital committee was set up in June, and which has given its report to the Indian insurance regulator IRDA in July 2017. And prior to 2016 also, a few years back, there was another risk-based committee was set up. So Indian regulator is working towards risk-based capital for some time now. The recommendation that is given by the committee is to implement risk-based capital in India by March 2021. uh, what is also recommended in the committee report, that the RBC regime will be based on the factor-based model as against the internal model. Before going into the full-fledged the application, the quantitative impact study will be performed, and the committee has also recommended the implementation of enterprise risk management, because as we have seen our slides presentation earlier, there is a direct benefit of enterprise risk management. It is also seen in China that there is a allowance for capital benefit of good implementation of enterprise risk management. India is going to adopt a twin peak approach. So prior to the submission of 2016 report on RBC, the Indian regulator also established another committee in 2014 to study the possibility of RBC jurisdiction. The committee recommended adopting of twin peak approach to the solvency, where the current prudential norm will continue to one peak and new risk-based capital will be employed as a second peak. The first peak would preserve the policyholders' protection on the current basis to allow companies time to fully understand the implication of the new system as a second peak. The next move from the regulator is awaited. Indian regulator has already taken certain steps which is required towards the risk-based capital regime. The risk-based capital regime has got three pillars. The first pillar is the calculation of economic capital or risk-based capital. In the second approach, second pillar, it is the risk management that is performed, and in the third pillar, there is a disclosure. So IRDA has came out with the revised corporate governance guidelines in 2016, and that has asked to set up various risk management committees and the asset liability management committees. So that exercise by the regulator is already done. Apart from that, the regulator has made chief risk officer position as one of the key positions in the insurance company. They have also suggested on the SST performing on the solvency position when the company do the valuation. Uh, the the regulator also asks for the economic capital calculation, but that calculation is performed more for an academic purpose, and there is no solvency is checked on the basis of economic capital. There you can check the ratio, but that is not performed for the purpose of determining the solvency of the company. uh, the regulator has also come up with the regular disclosure norms, which the every company is to do on a quarterly basis. They have to put their disclosures about the financials and other things onto their website. There's also a requirement from the Indian actuarial profession to furnish a financial condition report to the board. So, despite Indian regulator not going for full-fledged risk-based capital, but some of the activities which is required under the RBC regime, some activity has started happening. Up till now, we have seen that what the Indian regulators have done towards risk-based capital. In this slide, we see that what could be the possible impact of RBC on the Indian insurance sector. There could be a chance that the capital required post RBC is higher than the current required capital. As a result of that, there could be a chance that some of the smaller players uh, get merged with the bigger players, because on the basis of the strength of the capital, there could be a division between a stronger and a weaker player. The same situation has been observed in elsewhere where risk-based capital have been implemented. The same was observed in China, that the smaller players required more capital to support their business model. As a result of that, the action that the company may have to change is that towards the investment strategy, towards the product sales marketing, because that time it will not be the same portfolio of the product. The investment charge based on where you invest, the risk, the capital allocation will be different. So as a result of that, the investment side, there can be revised investment strategy by the insurance companies. Similarly, how to market the product, because there could be a shift in the product portfolio of the company. So it is anticipated that there will be changes coming once the risk-based capital is implemented. The advantage, you call it, or you call it, the differentiated strategy that the different company may have to adopt, is based on their appetite. So some player who has got more capital can still sell more of the guaranteed products, whereas a company with a lesser capital may have to um, focus their business objective towards unit linked and non unit linked and term insurance product. It has been observed in many markets where RBC is implemented that they have moved towards the lesser guaranteed products and focusing more on the protection product. Where low interest rate regime is prevailing, there is a focus on risk management in the area of lapse, expense, and mortality to generate surplus from these risks. And moving towards unit linked are the other options. So these are the expected changes that may happen once RBC is implemented in India. So if we summarize the possible changes post RBC implementation, will be in the product design, and then there could be change towards the investment strategy, because you have to align the investment based on your products. There could be some consolidations, and the bigger player, those who have got more deeper pockets, they will have more liberty to play. Uh, there could be, you can find that some of the smaller players may become regional players, because India is a vast country, and they may specialize in certain sectors where they feel that that they have a better understanding of the risk profile of the geography. So it is anticipated that some shift will happen post RBC implementation. The next topic that we are taking up is on the enterprise risk management, because we have seen that risk management and the capital position goes hand in hand, and those companies who are going to implement risk management more will find more benefit towards optimizing the capital position. So enterprise risk management is one of the very important components of the risk-based capital, and therefore in the next section we are covering how does the enterprise risk management and what are the things that will be required to implement the risk management towards the RBC. In the risk management, the objective is to basically identify the risk and manage the risk. So, the way we define the risk is the uncertainty that can derail meeting the objective of the company. So, that's a fundamental thing towards a risk, and the risk management is, that it enables company meet the objective in the presence of risk and optimize the capital position. So, risk management comes only when the risk is identified. Uh, Therefore, the first activity towards the risk management is the identification of the risk. Because if risk is not identified, it is impossible to find the mitigation action. So, the first stage towards risk management is to identify the risk, and there is a possibility that the company has identified hundreds of risks, but all those hundreds of risks are not important from the company's perspective and from the solvency of the company's perspective. So, therefore, it is important to quantify the risk so that it is possible to see that what is the total impact on the company, and the quantification is done generally based on uh, likelihood and the impact, and based on the likelihood and impact you can assess the overall criticality of the risk. So it is important to quantify the risk. Once the risk have been quantified, it means that we can rank the risk from order 1 to 100 and on the basis of either a total impact or on the basis of likelihood and impact, because how does the company is going to perceive what the risk is. Once that activity has been done, then you have to look at what treatment you're going to give to the risk. What treatment means that how you're going to manage the risk. Because once the risk is identified and quantified, there has to be an action plan ready so that if the risk happens, then that action plan can be brought into the practice. The next step comes towards the risk management is monitoring of the risk, because once you have identified, quantified, and have got an action plan, but still you have to continuously monitoring the risk. How does the risk is behaving? What changes are required? What changes are required in the assumptions? These things comes at a stage of risk monitoring, and once all these things happens, then it must be all the activities must be reported to the some committee, either in the risk based committee or to the board. So this is a complete process of the risk management through which the entire cycle get completed, and this ultimately feeds the risk based capital position of the company. Risk management, and in particular the enterprise risk management, is not a job of a few individuals. Uh, that's what the fundamental difference between enterprise risk management and risk management. In the silo risk management, few people or few departments in a company are responsible for the risk management activities, whereas in the enterprise risk management, the risk is managed across the company, right starting from the board to the last employee, right? So because risk is to be managed at all level. So all the business growth related objective from the business plan is mapped to the function except risk and audit and compliance. As each function have its expertise area, they must identify the risk that can fail to meet their objective and prepare action plan to manage the risk. So if those risks occur in reality, so all the functions, the frontline risk managers will have a responsibility to implement the mitigation plan. The, the second line, the risk function, is basically provide the oversight onto the risk management, and the third line is audit. So in the next slide, we shall see that how does the three lines stack up in the process of risk management. Risk-based capital and the enterprise risk management is following a three-line of defense model. What does this mean is that the first line is a business unit. So basically, the departments like finance, sales, marketing, all these departments are the frontline departments which do the business. So, except for the compliance and the risk team, will basically sits under the second line of defense, and their job is to oversee the risk management activities, and in the third line sits the audit. So the way it works is because the way we see that all the business objectives which is prepared during the business planning process is owned by the first line of defense, because say for example, if a business is to do 200 crore of new business, then the objective goes to the sales team, and which is then supported by marketing, and for the resources, the HR, the finance support. So all the objectives is owned by the frontline people, because they are the experts in their own line. Therefore, it is their responsibility to identify the risk. So in this, the three line of model, the one who is the owner of the objective is the owner of the risk. So it's their job to identify what the risks are, because if know that what are the risks, then it will be easier to achieve the objective. What second line does is basically ask questions to the first line, saying that have you identified all the risks or not. They do the job of a review and challenge to the what the first line has identified the risk, because risk team is not experts in all the areas. So but they are the experts in the risk activities. That is why they look from the company wide perspective, whether all the risks have been identified or not, and whether the risk management plan is developed properly or not. The third line of defense is basically the audit, who looks at the first and second line and provide assurance to the board about the internal controls within the company. In this slide, what we see that earlier we had seen, that what are the risks within the insurance company. In this slide, it is pictorially represented that what are the tools and techniques for the management of risk which is applied across the company, and which ultimately supports the risk based capital. So if you look at the financial risk is split into equity risk, interest rate, credit, and liquidity. And what are the tools and techniques to manage the risks within that? If you are investing in equity, you will prefer to invest in the blue chip companies. When you have got the interest rate risk, what you will do is that you will have asset liability management. You will do cash flow matching and look at the discounted mean term of assets and liabilities. So these are the tools and techniques to manage the interest rate risk. For the credit risk, you will invest where the rating is high, and there's also, you can apply certain investment limits through which you invest only up to a certain amount in a um, particular script, right? And that's how you can diversify your investment and manage the credit risk. For the liquidity risk, you basically manage your liquidity position over the next 12 months time. So these are some of the techniques through which you manage your financial risk. Coming to the insurance risk, there is a mortality, expense, and lapses. So these are the insurance risks within the life insurance companies. So the tools of managing mortality risk is you do underwriting at a proposal stage. You also do claim management when the claim arises, and to see that whether the information given at the time of death matches with the information which was given at the proposal stage or not. to basically uh, limit the exposure of the company, you reinsure your policies so that the high sum assured cases you can write. Also, you monitor your claim experience, and that's what the monitoring exercise. Similarly, to manage lapses, you look at the way how the company is selling the products, whether the sale is need based or not. You control the mis-selling, and for the expenses, there is a need to manage the expenses so that it does not go out of the hand. So these are some of the quantifiable financial and the insurance risks which you manage. The other risks are the operational risk, which is not straight away quantifiable, and you manage it through the risk control self assessment, where it is uh, the risks are the activity within the operational activities are split into the likelihood and the impact. Other risks are regulatory risks, and there can be other risks within the company. So, these are some of the tools and techniques through which the risks are managed under the enterprise risk management activity. Now, we have seen in this presentation this equation, we had seen it earlier, that overall risk capital position is the risk capital of each of the risk. Then there is a diversification allowance through correlation matrix, and then there is a benefit of risk management. So we have seen that how does the risk capital stack up in terms of the overall risk, the diversification, and its management. And here you can compare very much with the Solvency One regime, where the solvency capital was linked only to a formula. So the Solvency One and Solvency Two regimes are very different, and risk based under risk based capital, it is more dynamic in nature in terms of assessment of the risk, and that is one of the key reasons why risks are considered so importantly in this regime. So, risk management, it does not just help in the optimizing the capital. It also help in maximizing the profit, because if you look at the profit and the sources of profit, right, it again comes from the factor of financial risk and the insurance risk. So things like the expense, investment, mortality, lapses. So when we price a product, we make certain assumptions about these, and if our experience is worse than what we assumed, then we basically suffer losses. But if we manage the risks well and our experience is better than what we have assumed, then there is a surplus coming it out and profit is maximized. So, as a result of risk management and enterprise risk management, it not only just optimize the capital position, it also help in improving the profit of the company. Well, in this slide, I have brought together all the activities which is we have seen in this presentation. So, if how does the business is done? So, shareholders add the capital, and the objective of shareholder is basically to minimize the capital position and maximize the profit. And you can see that the profit side, which is light blue, is going on one side, which we just covered in the previous slide. And the one previous to that slide, we saw that how does the risk management is helping RBC, and that is coming on to the right hand side, which has got the same components of financial, insurance, and operational risk. Onto the above, you can see, which is pinkish slightly, that is the risk based decision. Though I have not covered risk based decision in this presentation, but risk based decision also helps in optimizing the capital position and overall profitability of it. So this slide is explaining that how does, by managing risk, you can not only optimize the capital, but also you can optimize the profit as well. So That's what the difference between the two regimes of the solvency. And how does, when we took the example of two companies with the exact equal size, now you can very well see that the two companies of equal size, how does risk management helps to one company which is doing very well risk management and the one company which is not doing risk management. So this is one of the key reasons why the risk management should be performed, and risk based capital help in giving this stimuli to the shareholders to basically enforce. And as a result of that, the position of chief risk officer is very important, because he is the custodian of all the risk policies, and according to his assessment, the risk management is going to be looked into. So thanks for listening to the presentation, and these are my contact details. I will be very happy to answer any question. um, you can WhatsApp me on my number. You can of course email me and ask any question, and of course we can get in touch over the LinkedIn. I'm quite active on the LinkedIn and generally respond very quickly. So thanks again, and please let me know that how you have liked the presentation. Thank you.